When valuing a business, do practitioners begin with the audited financial statements, where contingent liabilities are disclosed, or rely on management accounts which may not always include them? The choice of source can significantly influence the credibility and completeness of the valuation. Now let's begin with the basic. Contingent liabilities are potential obligations that depends on uncertain future events. They are not guaranteed, but they loom in the background. Think of lawsuits, regulatory fines, or product recalls. They remind us that valuation isn't just about what's on the balance sheets today, but what might hit tomorrow. In accounting, contingent liabilities fall into three categories. If the obligation is probable and estimable, it must be recorded as a liability. Now, if it is reasonably possible, it's disclosed in the notes but not booked. And if it is remote, no disclosure is required. The hierarchy is critical. Audited reports will show this disclosure, while management accounts often skip them, leaving valuers blind to risks that could materially affect values. Now let's look at some corporate cases. Meta faces a $1.4 trillion lawsuit over youth safety claims. It's disclosed but not booked because the outcome is uncertain. For Tesla, has recurring vehicles recall. When costs are estimable, they recorded directly. As for GM's case on ignition switch recalls led to billions in settlement, initially treated as contingent liabilities before becoming actual obligation. Now these examples show how contingent liabilities move from disclosure to real financial impact. In valuation practice, the treatment depends on whether the liability is quantifiable. A quantifiable contingent liabilities, like a recall with known repair costs, should be deducted from the enterprise value or adjusted in cash flow. And for unquantifiable risks, like uncertain litigation outcomes, are better reflected in the discount rate through a company's specific risk premium. The key is to avoid double counting. Don't deduct a liability and then also inflate the risk premium for the same issue. Here's the distinction between CSRP versus liabilities. Now, CSRP captures qualitative risks such as management quality, governance, customer concentration, whereas contingent liabilities are quantifiable obligations such as lawsuits, recalls, regulatory fines. Mixing the two muddies the valuation. Best practice is to keep them separate. Explicit adjustment for liabilities and CSRP for qualitative uncertainties. Liabilities remind us that valuation isn't just about numbers, it's about judgment. Whether disclosed in footnotes or reflected in enterprise value, they shape how investors perceive risk. And when risk can't be quantified, that's where CSRP comes in. Thank you for watching. If this breakdown of contingent liabilities and and their impact on accounting and valuation gives you new insights. Please give me a like, subscribe, comment, and share. By spreading these lessons, more entrepreneurs and SME can understand how uncertain obligations, from lawsuits to recall, shape financial disclosures and influence business value. Thank you.